Hi, this is John Comarianos. Welcome to a new edition of Capital Considered. I had a video up on this topic, namely the tariffs and the big market decline of last week, and I decided I didn't like it and I wanted to take the video down and do a new one. So this is the new version. Welcome. Thank you for joining. A few things I wanted to say. The first thing is regarding market declines. They are unnerving. Everyone knows that. If you are young, if you're certainly younger than 30 and maybe younger than 40, you want a market decline in some sense. This should not unnerve you. And the reason is because you have a lot of years of savings ahead of you. And the market has looked expensive lately on a number of metrics. The Shiller PE, for one, we've talked about that before. It's the current price of the market relative to the past 10 years average real or inflation-adjusted earnings. A decline in stock prices should be welcome to you. Now, I understand that if you're 30 or 40, you probably have some money invested in the market in your 401k, and that's declining. But you have so much savings ahead of you that this should actually be welcome to you. There's something we always quote in finance, average annual or annualized returns. And that's an important number, but it turns out that that number is more significant for a static portfolio. In other words, a portfolio that is not experiencing inflows or outflows. For portfolios that are experiencing inflows, so you're in savings mode in the younger part of your life, or for portfolios that are experiencing outflows, you're in distribution mode in the later part of your life, the sequence of returns, when you get big returns and bad returns, that matters much more than the annualized return. So think of it this way. If you're 30 years old, sure, you have some money saved, but probably not the bulk of the money that you'll ever save in your life. If you have a good job and prospects of keeping it and continuing to invest in your 401k, much of your savings will come later. You'll probably get promotions and make more money in your 40s than you're making in your 30s, and maybe again in your 50s you'll get a jump. And so you'll have more money saved when you're 40 than you did when you were 30. So you'd rather the market did poorly from 20 to 30 or 20 to 40 than it's going to do from 40 to 50 or 50 to 60 or 50 to 65 when you're probably going to retire. You want those big return years to come later when you're in savings mode. It's a little bit of the reverse when you're in distribution mode. Bad years in the beginning can kill you because you're taking distributions, the market's going down, and so your portfolio is declining for two reasons. And then when the market goes up, because you're constantly taking distributions, you don't give the improving market a chance to bring the portfolio all the way back to where it was. So sequence of returns matters when portfolios are when money's going into portfolios or when money's coming out of portfolios. The annualized number that we give so often for an investment really matters for static portfolios a lot more. So bottom line is, if you're young, this is welcome. You should hope for even a bigger market decline. If you're older, it's a problem. And so what I'll say about that is check your allocation. We had a video recently called Gut Check. I feel like I'm saying that a lot lately. If you're older, know what your stock exposure is. I am amazed that when the amount of investors and people I run into who are already working with an advisor who, when I ask them, what is your stock allocation? What is your basic allocation? They don't know. This is a time to check that. I would say if you're at retirement age, my preference is not to have a client more than 50% stocks, especially right now when markets look expensive, even with the declines of last week. By the way, the decline of last week, we had about a 10% decline cumulatively over Thursday and Friday. It's not the biggest S&P 500 decline ever, but it's one of the bigger ones certainly. So check your allocation, make sure it's reasonable for someone your age. And if you don't know what's reasonable, check with an advisor, please. I see a lot of people either in retirement or about to retire who, in my opinion, have way too much stock exposure. They've got the pedal to the metal as they did or should have when they were 20, 30, and 40. And if you're not 20, 30, or 40 anymore, you need to pull up on the pedal and not have so much stock exposure. And then these declines won't do as much damage to you. So the second thing I wanted to do was draw your attention to an article in the Wall Street Journal by Jason Zweig. Jason interviewed Jonathan Troussard, who we've had on this podcast previously. And Troussard in this article talks about a decision pyramid. So a number of decisions you can make regarding your portfolio, and they range from the ones that you may have the least regret about in the future to the ones you may have the most regret about in the future. Least regret would be something like doing tax loss harvesting. So taking an investment that has lost money, selling it, if it's in a taxable account, selling it, booking the loss, and then reinvesting in something similar so that you at least give yourself a loss to put on your taxes. That's something that you're likely not to have a lot of regret about in the future. Second level of the pyramid might be decisions that you could have some level of regret about in the future, but maybe not much. Those would be things like, maybe you could have more international stock exposure, so get some of that. Another thing might be have more TIPS bonds. And I should say, if you're considering that, make sure you consider doing it in your IRA, because TIPS bonds can present problems in taxable accounts. Consult with your advisor about doing something like that. And then the third level of the pyramid would be those decisions that you might have the greatest regret over in the future, and that would be something like altering your allocation a lot, selling out of stocks completely. It's true, the market may go down for the next week, month, year, 2 years, we don't know. At some point, however, especially if you're younger and have still some distance from retirement, the market may recover at some point. It'll be hard to know when to get back in, especially if you feel like a genius because you sold before it declined even more than it already has. And it'll be hard to say, okay, now's the bottom, or now is low enough, I'm going to get back in. Very hard to do that. Try to have some sense of what it might feel like in the future. We are notoriously bad as human beings at judging how we'll react or what we'll feel like in certain situations. And from long experience, I think I can tell you that if you've sold out of stocks and with the plan to get back in, it'll be hard to get back in. It'll be much harder than you think right now. You're gripped by fear right now. It's understandable, but try to gain some distance from that. It's Sunday as we're recording this, April 6th, so we're a couple of days from Thursday and Friday, maybe not long enough for a lot of that fear to dissipate, but hopefully some of it has dissipated and you can think a little bit more clearly right now. So that's the Jason Zweig article. I would encourage you to read that if you can, if you've got a Wall Street Journal subscription. We hope to have Jonathan on again and ask him more pointed behavioral finance questions. The last thing I'll say is if you've got a basic 60-40 portfolio, what we call in the business a balanced portfolio, and it's all U.S. stocks, you're probably down something like 7% for the year. That is not terrible. I know it feels bad. I know it's scary. I know the tariffs look like they could do even more damage, but 7% is really not that bad. When you do a risk questionnaire, typically with a financial advisor, the questionnaire asks you how much portfolio loss you can tolerate, and unfortunately it does it in percentages instead of dollars, which most people understand a lot better. But if you put 20% down, that questionnaire will likely, along with how you answer the other questions, but that questionnaire is likely to put you or recommend a moderate allocation or a balanced portfolio. So we're nowhere near a 20% loss. We're down 7 right now. That's not to say you can't have a 20% loss later this year in your balanced portfolio. You can. It's possible, but we're not down that far yet. Also, if you have the same balanced portfolio, 60-40, 60 stocks, 40 bonds, but the stock piece is in global stocks, you're actually down a little less than 4% this year. That's kind of nothing. That's, you should be able to tolerate that easily. If you've got 60% stock exposure, if you're with an advisor, you've gone through a risk questionnaire. I know the last 15 years or so, or more than that, since the end of the financial crisis have been great years, but we've had some bad moments. 2022 was a really bad moment. The S&P was down 18. The bond market was down 13. No one can remember that any time in the last 100 years or more. So 2022 is a bad year, but we have short memories. We remember only what's happened most recently. We call that recency bias. So remember how you were able to withstand 2022 when markets were down a lot more than they are now, and have some courage. But again, you may be in the wrong allocation. I see people all the time who I think are in the wrong allocation. So check it. Know how much of your money, what percentage of your money is in stocks. So those are the three things. Sequence of returns matters, and it depends on your age. The Jason Zweig article talks about a pyramid of decision and potential regret. And we're not down that far right now. We could go down more. No one knows what's in store, whether a recession is in store. I happen to think the percentage or the possibility is better than 50-50 that we'll have a recession. But, no one's very good at predicting these things, me included. So that doesn't mean much. No one also knows what the political situation is. And Donald Trump is trying to do some big things, lowering the value of the dollar, supporting the 10-year Treasury, maybe not supporting the stock market as much. So I'll leave you with one last thing. Our friend Brett Aarons wrote a good article about how Trump is starting to fight Jay Powell, the Fed chairman, a little bit. I think he wants Powell to lower rates because that would be beneficial for the stock market. Powell also said in his last meeting, maybe slightly antagonistically, that tariffs to the magnitude that we've seen them could be both recessionary and inflationary. He didn't use the word stagflation, but I think he meant that. So, the tension level could rise. Donald Trump likes the tension level to rise. I think staying calm in the face of that as much as you can is a good idea. And that's what I'll leave you with. So this is John Kamarianos for Capital Considered on the tariffs, on the stock market declines, signing off for now. Thank you for watching.